Okay. All right. So welcome back. So this is going to be the second part of chapter 10 right here. So the first part we learned about receivables, right? Now here is going to be something that we're going to be learning about called time value of money. Okay. So time value of money. Well, of course, every time we collect money, we have to also understand that the value of the dollar actually does not hold its value. It over time, it ends up losing its value or it ends up increasing its value. Okay, and there's many reasons that the U.S. dollar can lose its value over time due to inflation. Pumping more money into the government, or even a recession, depression, et cetera, or even an economic uplift, right? Those things can usually, change the value of a dollar in over time, right? A dollar 20 years ago does not hold its value up to today, right? Today, the dollar has definitely lost its value over time, right? So, but back then, 20 years ago, right, a dollar can do much. And, the price of, food and things that were a lot more cheaper back then 20 years ago. Now, fast forward today, it's a lot more expensive to purchase things now, right? And we have seen the dollar expand, especially in our jobs, right? When we're seeing that the the wage is increasing, right? The standard of living is the standard cost of living has also increased. So that is what happens over time. That we have to assume that the dollar loses its value over time. Now, of course, with the historical cost, not historical cost, the monetary assumption, right? We have to assume that, well, when we take a unit of our dollar, at least to us, a dollar is still considered a dollar, right? How do we measure that our dollar should increase or decrease its value over time? We can't really predict that, right? It's all due to the economic, current situation during the economic times. Right now, it's expensive, but still, the dollar is still considered a dollar, right? So that's why what we're going to do here is we're going to take a look at time value of money. We are assuming that with this type of money, that we can assume that when a dollar now is going to stay the same in the future, okay? It's not going to change that much, especially within 2 or 3 years. It's not going to change that much. If it's like anywhere for 5 years or 20 years, maybe it will change a little bit, but it's not going to increase that much. So the assumption here is we're going to take a look at two different types of interest that we can assume, so we know how much our dollar can expand in time. Okay? So we have the simple interest and we have the compound interest. Okay? Simple interest, right? It's pretty straightforward. It's where you have a lump sum money, right? And you get you calculate interest only once. Okay? And how does this work? Well, you're gonna have a few variables, right? We have P for principal, which is going to be your original investment. Okay? You have your rate, your interest rate. Interest rate will always be in terms of an annual percentage, unless otherwise, like maybe it's 0.5% per month, right? It will specify, but if there is no specification, then your assumption is that interest rates are usually given in terms of an annual rate. So this is what they charge you per year, okay? And then T, which is time, right? Usually, right, we treat time in terms of years as well. Now, of course, we can have situations where what if it's less than a year? What if it's 36 months, right? Same thing, that's 3 years. So in this case, usually when we treat time, right, to keep it consistent because we have an annual rate, the way that we keep it consistent is making sure that the time is also in terms of years. Okay? So that is simple interest, okay? And we'll talk about compound interest, okay? Compound interest, right, is when we have a lump sum money. But the thing about compound interest is that there is a, you're going to have a new factor, which is called the number of times compounded. So that means you're going to be calculating interest more than once, okay? Depending on how many times it's compounded. So if it's compounded every month, right, then you're going to get, you're going to have to calculate interest basically 12 every single month, right? You're doing it 12 times a month or 12 times a year, okay? So with that interesting feature there, right, that means you're going to be doubling up the money in terms of how many times you're going to be collecting interest. And here is where you'll get, this is where a lot of companies get you, because when it is compound interest, right, you are being charged or calculated interest on top of interest on top of interest, okay? So we'll take a look in a few minutes of how that actually works, right? We'll take a look at an example of a loan or a credit card example, okay? But typically, most bank bonds are simple interest because usually you put a lump sum money in either some kind of savings, or if you purchase a bank security or a bank bond, usually those are simple interest. They get charged only once a year, and that's it. It's one lump sum money that get charged once to one time, and that's it. Okay? Whereas compound interest, you're going to be recalculating based on the number of times compounded. So in this case, right, we have the same exact variables. The only difference is you have one key feature, which is going to be an additional variable called n, which is going to be considered the number of times compounded. Okay, so how many times are you going to be calculating interest? Okay, so let's go ahead and focus on the simple interest first. So this one is pretty straightforward, pretty easy, since it's being only calculated once. Your interest is going to be principal times rate times time. All right, or also known as pretty, right? P equals P times R times T equals I, right? Pretty. Okay. So this one's straightforward, and future value is going to be your principal plus your interest. All right, so down below, so I have the formula at top, and down below it's the actual equation. So this one you could do with a simple calculator. All right, P times R times T, and then future value is going to be your principal plus your interest. Okay, so let's go ahead and take a look at an example here. All right, so the example is that you bought a bank bond, okay? Excuse me. You bought a bank bond, okay? And that bank bond is worth $100,000, okay? The interest rate is 6% and can be redeemable in 5 years, okay? So here you go, right? Your principal is $100,000. Rate, you're going to convert it in terms of decimals. So in this case, 6% is also known as 0.06%, or sorry, 0.06 as a decimal. And you have time is in 5 years. It's already in terms of years. Okay? So the formula here is principal times rate times time. So you're going to take your 100,000, you're going to multiply 0.06, and you're going to multiply that by 5, okay? And what you're going to solve here is $30,000, okay? Now, how do I know how my future value is? So if my original investment was $100,000, in 5 years from now, that means my future value, which is also known as my principal plus my interest, is going to be, by the end of the 5th year, I'd be able to redeem it, and the value is going to be $130,000. Okay, so over 6 years, I've collected $30,000. Okay. Now, usually bank bonds or bank securities, they usually have a really low rate. So, I mean, in this case, this is where you have to kind of look at what kind of bank securities are you actually looking to invest in. Again, because in this kind of case, right, if you are looking for a bank security there or some kind of savings, your best bet is you're not going to get the biggest percentage of interest to collect. But yes, in this case, this is a real life scenario where you are getting a bank security. Even though you put in a lot of money in there, it didn't really grow that much in terms of time and in terms of percentage wise. But that's a pretty good deal for a 6%. It's pretty rare to find. Okay, usually you'll see like a lot of other places that are like maybe 2.3% or even 4%, things like that. So in this case, right, when we're looking at a bank bond, right, if I originally invest $100,000 at the end of 5 years at a 6% rate, APR, right, it's going to come out to be $30,000 interest. So that means when I do pick it up or redeem it in 5 years, it's going to be a total of $130,000. Okay. So then, right, so that was simple interest, right? Pretty straightforward. Now, compound interest is going to be one of the harder ones that you're going to have to deal with. In this case, you would need a graphing calculator, okay? Not a scientific calculator. That's not going to get you far. You could maybe be able to do it, but I believe you do need the one, because you need to use the caret, which is the exponent, or be able to put in the parentheses and stuff. So in this case, I'm not expecting you to buy a really expensive calculator, right? Because we have Excel. And I'm going to show you how to punch it into Excel. Okay, Excel for you guys is free. So here you go, right? How is the formula to solve for compound interest? Well, here you go. Interest is going to be future value minus principal. Okay, so what's future value? Future value is going to be the principal times 1 plus the rate divided by the number of times compounded, parentheses, exponent, which is multiplied by itself, right? Exponent to the number of times compounded times time power. Okay, so if you look down below into the equation, right, interest is equal future value minus principal, but future value is equal to P times 1 plus R over N, parentheses, up to the NT power. Okay, so this case, right, how am I going to do this on Excel? Well, I will show you in a minute here. So again, same scenario, except this time, right? I bought a bank bond for $100,000. Its rate is going to be 6%, and it's compounded quarterly. Okay, so and it can be redeemed in 5 years. So in this case, how many times is quarterly? It's right every quarter. Right, so that means it's going to be every 3 months, so 4 times a year, quarterly. So it's going to be 4 times. Okay, so let's plug it into our original formula, because right, in order to solve for interest, you need to solve for future value. Okay, so this is how I'm going to plug it into my Excel worksheet. So you're going to punch in P asterisk, or your multiplication key, right? Open parentheses, 1 plus open parentheses, R divided by N, close parentheses, caret, which is your shift 6, okay? Open parentheses, N times T with the close parentheses, okay? It is very, very important that you put in the same amount of parentheses as an open parentheses to close out with the same exact amount of close parentheses, okay? It is very crucial. The reason why we have to do all these parentheses is because Excel is pretty straightforward in terms of if you're going to tell it to calculate 1 plus 1, then you need to separate it. You need to make sure that you do parentheses because it uses PEMDAS, just exactly like how we're taught in math, that we have to use parentheses first, then multiplication. No, it goes parentheses, exponents, then it goes multiplication, division, addition, subtraction, right? PEMDAS. All right? So we have to go in that exact order of operations. So this does exactly the same. You need to tell Excel what you want to calculate first. And in this case, the most important thing is you need to know that the rate needs to be divided by N first. Okay? Then you need to add the 1. And then from there, right, you need to put it up to the square root. Or not square root, what do you call the exponent? And then you need to calculate what N times T is. Okay? So that you have to be very specific in there. If you miss a parenthesis somewhere, you will get an error code. Okay? And you could accidentally say, well, I want 1 plus R, then divide by N. And that's going to mess up your formula 100%, right? That's not the same thing. 1 plus R divided by N is not the same thing as 1 plus R divided by N. Okay? All right? So it's very crucial that you do have these parentheses put into place, okay? So if you were to plug it in, right? Again, this is a PowerPoint. We'll do an example in Excel later, okay? Where $100,000 times 1 plus 0.06 divided by 4, okay, up to 4 times 5, okay, gives you a total of $134,685.50. So therefore, if my interest is going to be future value minus my principal, then I get a total interest of $34,685.50. Okay? So comparing and contrasting, right, the difference between the simple interest and the compound interest, right, you get a little more here, right? You get $4,685 more because you get the interest percentage multiplied or times the principal more than once. Okay? Now, depending on the situation, it's not always true that compound interest is always better, okay? There are situations where sometimes when you take a look at the outcome and you do calculate simple versus compound side by side, you're going to see that sometimes the simple interest might output more than the compound, okay? So that's the example here. Any questions so far?
No.
Okay. So how do we journalize this? Well, right, let's take a look at the first thing, right? When we journalize that we bought a bank bond in the first place, right, you're going to recognize that you bought a bank bond and you had to pay cash for it, right? So in this case, you bought it for $100,000, right? Fast forward, if you decide to redeem it in 5 years, then this is what the journal is going to look like after you've calculated, right? Depending on whether it's simple interest or compound interest, right? So in this case, this scenario tells you that that this $100,000 is compounded quarterly and is to be redeemable in 5 years. So here, when we redeem our in our bank bond or bank security, this is what you're going to recognize. You're going to recognize checking. You're going to recognize your bank. What happened there? You're gonna recognize your bank security, and what's gonna happen is you're gonna have what's called interest income, right? Because you generated revenue or you generated income off of interest. Okay? And you did it for the difference amount. So your interest is going to be your interest income. All right? And this is how you're going to journalize it if you do in the future are going to record or purchase a bank bond or whatever it is that you do, right? So here's going to be the difference between a bank bond, and we'll talk about a loan in a second, okay? So how is interest actually calculated, right? At our standpoint, right, we can only do so much to calculate how much interest it actually works. But let's actually take a look, right? If I were to do a bank bond, right, for 5 years, how is the interest actually calculated? Especially when it comes to compound interest, right? With a simple interest, we already know. You just multiply the interest rate one time. But in this case, we're looking into compound interest. How do we determine how the actual interest is actually calculated? Okay? So let's take a look. Well, let's take a look at an example right here where we're going to be taking a look at how to calculate how much interest. So again, we talked about how every single time when you have a principal, right, and every time you make a payment, right, what happens, it decreases your principal, right? In most cases, that is actually not true. Believe it or not, you actually, depending on what bank that you are borrowing this money from, or whatever bank bond you are looking at, especially, we're going to take a look at a loan because that's just more kind of a clear example of this. You're going to see that you're going to end up actually paying for the interest first. Usually that is always true. And you know what? You don't, what is it? You actually, before you even borrow the money in the first place, what's going to happen is interest is already pre-calculated. Okay? What does that even mean? That means before you sign that contract and you make agreement terms, right? They've already calculated how much interest you are going to be paying for that loan, right? And when they've already calculated how much interest you've already are going to be, having to pay into, they're already going to tack it on as part of your total amount that you are going to owe, and they're going to make your payments based off of that. So the interest is already calculated, and it's already part of what's called the actual amount that you actually owe besides the principal. So you're going to have the principal including the interest that you are calculating, okay? So how does that actually work? Okay, well, let's take a look, okay? If on January 5th you decide to borrow a bank loan for $10,000, okay, and it has an interest of 4.75% APR, and it is compounded monthly. So that means every month you're going to be calculating interest, okay? And then, of course, the bank approves the loan and expects to be paid back in 5 years, okay? In full in 5 years, okay? Usually, these kind of loans, right? We know for sure that these kind of loans, we usually, they don't give you too much of a deferral. They'll usually charge interest right away, okay? But in this case, it's never the day that you get it, right? It's always you accrue interest the month after. Okay. So in this case, what we're going to do is here we're going to say, well, we borrowed money, so that means we got $10,000 in our checking account, and we now owe a bank loan for $10,000. Okay. So then that's going to go into your little table here. Okay. Now, usually for the first month, right, you usually get interest free because you don't accrue interest until the month after, right? Usually because when you get it, then that's when you start accruing. Okay, so in this case, we don't have any interest. So that means your principal or your current balance here as of January is going to hold $10,000. Okay, and you haven't made a payment yet because it's January, right? You just got the loan. So right now, your new balance is right now currently $10,000. Okay. Then, when you are ready to calculate for the interest as of for the next month, right? What's going to happen is that, well, you need to calculate, right? Since it's being compounded every month, right? You're going to figure the numbers out and find out how much is the rate going to be charged per month. Okay? So this is where we're going to figure out, okay, well, we take our principal, right? We're going to go figure out how much is the interest rate going to be. If it's 4.75%, right? And of course, it is, since it's an annual rate, and we are going to be calculating it every single month, we're going to take that 4.75%, right? And we're going to divide it because that's an annual rate. We cannot use an annual rate to calculate per month, right? We must use the rate divided by 12 to give us the accurate amount of rate. So in this case, it's going to be 0.003458, right? That's 4.75 divided by 12, okay, to give you this number here, right? And what's going to happen is that now, how much is your interest that you're going to collect? Straightforward, right? You take your principal times your rate, and that's going to give you $39.58. So what's going to happen is, this is what's going to happen. That's going to be tacked on to your principal. So then you have a current balance of $100,039.58. And now you're expected to make a payment. Now, in this case, right, the bank is actually going to be smart about it, right? They're already going to pre-calculate you your exact amount of payments you need to make depending on what the terms is, right? So the terms is 5 years. So if you have 5 years to pay off this loan, this amount right here of the $187.57 is already a pre-calculated amount. They've already did what's called the compound interest, right? They've already calculated what your total ending future value is going to be in the end of 5 years. And they take that and divide it by the total number of payments, and that's where this payment number comes from. All right? That's what they do for, they crunch these numbers and say, hey, this is what you owe. Now, of course, you have the option, right? You have the option to either pay the minimum, or you could choose to pay more. If you pay more, right, then again, if you pay more, then yes, you will lessen your principal by a significant amount, but again, it's going to be constantly recalculated if you pay more than the minimum. Okay, so in this case, right, we're going to pay $187.57. Now that's our payment. So therefore, if we make this payment, right, then let's see how much is actually going to be reduced. Now in this case, right, we've calculated how much interest is going to cost me. Interest is $39.58. Now, if you did not know this, you're always going to pay interest first, okay? Always, you're always going to pay interest first. And then whatever amount of money that you have left over from your payment, that is actually going to go towards your actual principal, okay? So this $187.57, a part of it's going to pay off the interest, and then the part of it's going to end up paying the bank loan, okay? And this is how loan sharks get their money, because you're expected to pay a certain amount of money. So in this case, if I'm making a payment of $87.57, how much is it going to go to interest and how much is it going to go to the principal? In this case, right, we've already calculated that the interest was $39.58. So therefore, we need to do some math here. How much of this actual payment of $187 is actually going to go to my principal? Since I've already paid off my interest of $39.58, right? Then whatever remaining amount is going to go towards the actual principal, which means here you go, I have $147.99 is actually going to go to my principal, okay? So this is where a lot of loan sharks get you too, because you are going to be constantly trying to make a payment to your loan, and you're never going to see it go down because you're always going to pay the interest first. Now, if you remember, right, when we calculated this exact scenario, you're going to be paying $34,000 worth of interest, okay? $34,000 in interest, okay? Now, here's a few things that you can do as well. If you really want to reduce your principal and reduce the amount of interest that you're being collected, in this case, you can never go around that. You could pay your loan a lot quicker. Yes, the longer you have it there, yes, you could potentially accrue more interest. But like I've mentioned before, right, this number is already pre-calculated. At the end of the day, whether you think you extend your loan, if you extend your loan for longer, like refinance it, then yes, you will 100% collect more interest. But if you choose to pay it off sooner, you will never go around to paying. You have to always pay the interest first. It's already calculated as a total grand total amount. It's just the subject of how often can you pay it and how quickly can you pay it. So in this case, you already are paying the interest regardless of what agreement terms you have, okay? Now, yes, you can do this too. If you want to pay it off sooner, you can call the bank and make a second payment. This is very crucial, okay? The second payment is the only one that you can actually pay off the actual principal, okay? But the very first payment, you always have to pay the interest first, and then whatever amount that's remaining is actually going to go towards your actual principal, okay? So just a little fun fact there. So in this case, I've calculated that $147.99 is actually going to go towards my principal. So I'm going to plug that number in, and now I'm going to be having a new balance of $9,852.01. Now, once again, you already paid the interest off, and now you only shorten your principal now down by 147. So this is what I mean by if you just continue to keep paying the minimum, right? You're constantly calculating interest on top of the interest, because here, right, how do we calculate the next round of interest? Well, for the month of March, you're going to take this principal right here, or in this case, your new balance, which includes your already calculated amount of interest, right? That is what you're going to be calculating the next round of interest on. So this is where you have to be very careful too, is that at the end of the day, you will be charged interest on top of interest on top of interest. Okay? And let's say you have a deferred payment, right? You don't need to pay it now. As you accrue, right? If you didn't make a payment in January and you accrued it, right? The next time you get charged the interest rate, it's going to be based on $139,058. So you're getting charge interest on top of interest on top of interest. Okay, that's if you use the deferral payment method. Okay, and that is how you calculate, how it works. Now again, let's do the example for March. So I'm carrying my new current balance down over. So now I have to recalculate a new amount, right? Since I already know how much my rate is per month, right? When I calculate that, now my next amount is $39. It's going to be my interest. So as you can see, yes, your interest does get dropped lower, 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 lower every single time you make a payment. However, at the end of the day, you're going to pay all the interest off first, and then you will slowly pay off your principal. So at the end of the day, it doesn't matter how much interest you actually have to pay. You're going to end up paying it off anyways. Okay, so there you go. Now your new current balance is now $9,891.01. Again, you make your payment again of the $187.57. So here you drop down to this much amount. Okay, so again, you're going to pay $39 of interest, and then whatever remaining amount is actually going to go towards the actual principal. Okay, and so on and so forth. Okay, that is how interest is calculated, especially for a compound interest. Okay, it doesn't really matter because they calculate that as a lump sum. This is how you're looking at it in terms of a month-to-month basis. How are they actually calculating this interest for you every single month? This is how they do it. Okay, any questions here?
Yeah.
Okay, this is a real life scenario. So this is how you are able to make your decision here, because now you have some extra knowledge. You know exactly what to look for, especially if you do plan on accepting a loan or going for a credit card, right? What are the terms? What are the percentage rates? How much are you going to get charged interest? How much is it? Credit cards are normally compounded every month, right? Loans, depending on what the agreement terms are, they could be every day, right? You could accrue interest every day. But most cases, most home loans, or if not most residential loans, usually are charged, you accrue the interest every month. But anything for like a car loan, those are usually based on every single day. Okay, so it really depends on what kind of loan that you do take a look into. But typically, when you do borrow money, this is how they calculate the interest. Okay. So let's go ahead and do our example here. Okay. Oops. Okay, so let's go ahead and do our example here, where we have the chapter 10.2 exercises. So let's go ahead and take a look. Okay. So here you go. Question number 1 is going to ask you, all right, that this is a simple interest question, all right. Principal times rate times time, okay, and then future value is your principal plus your interest, okay. So in this case, question number 1 says that you bought a bank bond worth $500,000, okay. The simple interest rate is 7.45% and can be redeemable after 3 years, okay. How much interest will you collect at the end of 3 years? All right, so let's go ahead and plug our numbers in. So we have a principal of 225,500. We have the percentage rate of 7.45%. Okay. We have the time in 3 years. Okay, so what is going to be your total interest after 3 years. So what's your total amount of interest that you will be collecting? Right? I put a reminder. So you take your principal of 200, 25, 500. You're going to multiply the rate by 0.0745, and you're going to multiply it by the time, which is 3 years. So how much interest are you going to be collecting? Okay, 50,399.25. So that means in grand total, when you do collect um, the bank bond, how much is it going to be worth? So I'm asking you for future value. In 3 years, how much is the bank bond going to be worth? $275,899 and 25 cents. Okay, right? Straightforward. Okay. All right, so question 2 is going to ask you a series of questions, and you're just going to be answering right here the interest and the future value. Okay. All right. So let's go ahead and do these examples here. So if I have a principal of $15,000 and I have a rate of 5.12% and it's in 5 years, what is my interest here?
38.40.
38.40. Okay. Okay, so it's going to be my 15,000 times 0.0512 times 5 gives you 3,840. So therefore, what's my future value going to be?
18,840.
18,840. Okay, good. So if I have a principal of $4,521.50 and I have a interest rate of 2.45% and I have 90 days. Now in this case, my time is not in terms of years, it's in terms of 90 days. So what am I going to do with this number here?
Do you turn it into a fraction of a quarter?
You do turn it into a fraction. Okay, so in this case, right, if we know that 1 month is equal to 30 days, okay, and we know there are 12 months in equals 1 year, okay, let's go ahead and do the math. So 90 days, how many months is 90 days? 3 months. All right. So in that case, how much is it compared to a year? 3 months out of 12 is what?
Quarter.
Good, right? 3 divided by 12 is a quarter of a year. Okay. So let's go ahead and calculate that. What's my interest off of this? Okay. So if I have 4,521.50 times 0.0245 times a quarter of the year, how much interest am I collecting?
$27.69.
$29.69. So therefore, what's my principal, what's my future value going to be?
$4,549.19.
Good. Okay. What about this one where I have 384,125.22 and I have an interest rate of 7.89% and it's 6 months. Okay, so 6 months, right? 6 divided by 12 is half a year. Okay, so how do I figure out how much interest I'm going to be collecting? Okay. So then what is my future value going to be? Good. Okay. So there you go. That's simple interest for you. Okay. So let's take a look at question number 3 here. Okay. So question number 3, we're going to be now looking at a compound interest example here. So question number 3 says that you were approved for a bank loan for $5,500. Interest rate is 6.25% and is compounded monthly. Okay? How much interest will be collected if you decide to pay off the loan in 5 years? Okay, so here you go. I plugged in all the numbers for you, right? We got 5,500 is your principal. Your rate is 0.0625, right? Your number of times compounded is 12 because it's every month, okay? And you have 5 years to redeem it. So this is how we're going to solve for the future value, okay? You're going to put your equal because that does your formula or your equation in Excel. Okay, so equal sign first. All right, you're going to put in your principal, right? So whether you cell reference or whether you type in your numbers, it doesn't matter. But I'm going to type in my numbers so you know exactly what numbers I'm using. I'm going to do my principal first, right? Of the 5,500. Okay, I'm going to use my asterisk or my star because that's to multiply, right? I'm going to open up my first parenthesis. All right, I need to have 1 plus my second open parentheses, and now I need my rate. My rate is 0.0625, and I'm going to divide that by the number of times compounded, which is 12 times. I'm going to close my parentheses twice, okay? As you can see, I have a red parentheses and I have a black parentheses. I need to make sure I have the same amount of parentheses that I put in there, okay? I'm going to shift 6, which gives you your caret, and then I'm going to open up another parentheses, and I'm going to do my n times t. So in this case, it is 12 times 5, because that's your t, okay? And I'm going to close my parentheses. And that's when I have everything that looks good. I'm going to press enter. And then I get $7,511.51 for the future value. So in this case, how much is my total interest?
2011.51.
Right? So you're going to take your future value minus your principal, which gives you $2,011.51 worth of interest, okay? So once again, You cannot use a regular calculator to do this, okay? So your best bet is to use Excel. I do not want you to go out and buy an expensive calculator just to do this one section. This is the only time we're going to be using exponents in this entire course, right? So in this case, I do not want you to do that. Now you can find online a scientific calculator that can do exponents. I believe Windows has the capabilities to do it. So if you go down to your Windows and type in your calculator, I believe you can do the calculation on your computer. But again, why do it on your computer when you can do it straight into Excel? It's going to be the same thing. Okay? All right. So here we got $2,011.51 worth of interest. Okay. So let's go ahead and do some more examples here. Okay. But this time we have some, yes.
I have a question. Good morning.
Okay.
Why you put 1 plus? What is this 1?
It's when you do a rate, right? Especially when you're trying to figure out how much to include, right? That 1 is basically saying you're multiplying it by the actual principal times that 1 time. I don't know if that makes any sense. As in, like, for tax, right? If you just do your straight calculation of the amount that you owe times the tax, right? Without the 1, it's going to give you the tax. Then you have to add the amount that you owe, right? In this case, that's what you're doing here. You're adding the principal automatically when you calculate this amount. So that 1 plus the rate is what you're going to get.
You mean principal? It is 1. It is principal.
Yes.
Thank you.
That 1 is the principal plus the rate. Correct. Okay. All right, so going back to this. So now you have the same scenarios, except you have a new feature, which is the number of times it is compounded. So let's go ahead and practice that formula, okay? So for future value, how much is it going to be if you have a $15,000 principal at 0.0512%, okay? And it's compounded at quarterly, and you have it's the times is 5 times, 5 years, excuse me, 5 years. Your time is 5 years. So in this case, right, let's practice this once again. So we have $15,000 times your open parentheses 1 plus open parentheses your rate of 0.512, okay, divided by the number times compounded, which is going to be 4. Close your parentheses twice. You're going to caret, open parentheses, your number times compounded times time, which is 5 years. So in this case, how much is your future value going to be? Okay, in this case, I should ask, who is actually using Excel?
I'm not.
I'm trying to do it. It's just I'm really a slow typer on the laptop.
That's fine. That's fine.
Yeah.
Sorry, I'm on my phone.
That's completely fine. I don't believe you can do it on your phone. I don't think it has the capability to do exponents. Unless you expand it, depending on what kind of phone you have.
$19,344 and 84 cents.
Good. Okay, so in this case, I should have used equal round for this formula, but that's okay. It should, we'll usually you're supposed to do equal round. So in this case, right, but that is correct. You're going to round that to 84 cents. So what is the total amount of interest that you're going to be collecting?
$4,344 and 84 cents.
Okay, 4,344.84. Okay. So then what about this one where we have 90 days? 90 days, right? We've already done this before in the previous one. 90 days is going to be equal to 3 months, okay? And 3 months compared to a whole year, so 3 out of 12 will give you 0.25. So time is 0.25. So in this case, right, let's figure out the future value together, okay? It's going to be your principal of your $4,521.50 times 1 plus, open parentheses, your rate of the 2.45%, okay, divided by the number of times compounded, which is 2, close parentheses, twice, caret, open parentheses, the number of times compounded, all right, times 0.025. Okay, so in this case, what is your total future value going to be?
$4,549 and 11 cents.
Okay, which then, how much interest are you actually collecting?
$27.61.
27.61. Okay. Last scenario here, we have $3,804 and 125.22 with an interest rate of 7.89%. With number of times compounded is 3, and you have 6 months. So again, 6 months, right? Divided by 12 will give you half a year, 0.5. Okay, so let's go ahead and figure this out again. So principal of 384,125.22 times 1 plus, open parentheses, the rate of 0.0789 divided by the number of times compounded, which is 3, close parentheses, caret, open parentheses, 3 times 0.5 because that's the time. So in this case, what is my future value going to be here?
39. No, 399, 378, and 20.
Perfect. Okay. So then, how much interest are you actually collecting?
Uh, 15,252 and 94.
Okay, good. So let's go ahead and compare this, right? Because this is the same exact scenario that we have for the simple interest. Okay, simple interest was on this one, right? So this was how much interest I collected using compound interest. So the first one was 4,344.84. The first one that we did here was only 3,840. See, so that one increased a lot. Okay. Um, compared to doing the compound, right? You gained a lot more money. For the second one, right, we only calculated $27.61, where simple interest you got $27.69. So you got 8 cents more for this one. And then this one you have 15,153.74. And let's take a look here where compared to this one you have 15,252. So in this case, the difference between the two is very, very minimal, okay? It's not that drastically different. So whether you do make a decision whether to use a simple interest or a compound interest, you just have to take a look. Do you prefer to get, you know, interest more often, or do you prefer to get interest once? Now, depending on a bank loan, it would be nice if you could have interest only once, but that's not how loans work. That only happens for bank securities, okay? Where loans or any type of liability, usually you get it's compounded, okay? All right. Last question for before we go on break is we're going to go ahead and practice getting a loan, okay? We're going to journalize it and we're going to practice calculating how much we need to make a payment to and so on and so forth. So, question number 5 says journalize the bank loan from example number 3, okay? The bank loan was made on June 1st of 2020, okay? Monthly payments are variable, okay, depending on how much you want to pay. And of course, due every first of the month, okay? There are no hidden fees or 0% APR. Like, so there's no deferral payment period, okay? So that means interest is going to start calculating as soon as possible and payments are supposed to be made the month after, okay? So again, the bank loan is effective immediately, okay? So let's go ahead and journalize the first 3 months of payments, okay? So let's go ahead and refer back to example number 3 here. What kind of loan did we get? We got a bank loan, which was for $5,500. The interest rate is 6.25%, and you're going to plan to pay it off in 5 years, okay? So in this case, right, we've already looked at what my future value is, and of course, we're gonna take a look at how many like what happens when we make a payment. Okay. So we borrowed $5,500. So let's go ahead and journalize that as of June 1st. We obtain a bank loan for $5,500. Okay. Now, in this case, right, what happens when I borrow money? How do I journalize that I borrowed money?
No clue.
Okay.
checking, right? We borrowed money, so that means we got money in our checking account. So let me go ahead and reformat this. Sorry. Okay, so that's the very first thing that we're going to recognize here is since we borrowed money from the bank, that means we got money in our checking account. And what's my credit going to be? I end up accruing a liability, right?
Yeah, with a bank loan.
Good, correct. Bank loan. Okay, and I borrowed $5,500. Okay, straightforward. Do I need to record my interest?
Yes.
Why?
Because that's a separate thing.
It is a separate thing, but in this case, I just got the bank loan. Do they charge? Have I accrued interest yet?
No.
No. So in this case, you're done here. You borrowed the money, done. Okay. You only start accruing the money as soon as you get the money. Okay. So in this case, when you got the money, you haven't accrued anything yet. The next day starts accruing, or the next following month it accrues. So in this case, that's where this table is going to come into play. So in the month of June, I borrowed money, okay? Now, my interest rate. If I'm going to calculate for my next month how much interest I'm going to be collecting, right? Then let's go ahead and take a look at my rate. My rate here is going to be my 0.0625%, right? That was my interest rate. I'm going to double confirm that. Question 3, interest rate is 6.25%. Okay. Now, if I'm getting compounded every single month, right, this annual rate that I have here is in terms of 1 full year. So I need to divide this by 12 to figure out what the accurate amount of rate I'm going to be charging for my interest. So in this case, it's going to be 0.0, okay, 0.05208, okay? That is the 6.25% divided by 12. Okay, so I'm going to do that again so you guys can see that, okay? So 0.0625 divided by 12, which is my interest rate divided by 12. That means every single month, this is how much interest I'm going to be calculating, okay? So let's go ahead and figure out what is my monthly interest as of for the month of June to July. How much interest will I accrue? Okay, I guess I'll let you see the numbers first.
Uh, 28.65.
Okay, so let's go ahead and see that. So it's going to equal round 5,500 times my 0.005208, comma 2. So I get a total of $28.65 worth of interest. Okay, so therefore, what is my current balance going to be as of my July statement? So in this case, what's my future value for July?
Oh, 55, 28.65.
5528.65. Okay, good. So that means, okay, so that's how much I'm going to get billed for as of July. Now, when July rolls around, I'm going to make a payment of $200. Okay, so if I'm going to make a payment of $200, okay, so let's go ahead and make the payment of $200. So it is now July 1st. Okay. And I'm making a payment. What do I need to pay first?
The interest.
You're always gonna pay the interest. So in this case, I'm gonna recognize in this case I'm gonna make a payment to my loan, right? So that's the first thing you're gonna recognize is that you're gonna make a loan payment, and of course you always pay the interest first. So in this case, interest expense is going to be when you pay for the current year, but if you're gonna pay it later, interest payable. Okay? And of course, I'm gonna be paying it using my checking account, right? Whether I pay online, pay via credit card or whatever it is, right? It's gonna come out of your checking account. Okay. All right. So in this case, how much was my so let's talk about the payment. For the month of July, I'm making a payment of $200. Okay. And how much interest am I going to pay off first?
28.65.
$28.65. Okay, so then how much of this $200 payment is going to actually go towards my principal? So if I made a payment of $200 and I had to pay $28.65 of interest first, how much money is actually going to go towards my actual principal?
$171.35.
Set 171.35. Okay, so that means, right, your new current balance is going to be the current balance minus the payment is going to be now your new principal. Okay, so in this case, your new balance here is depending on how you want to look at it, I'm going to just keep it consistent here, okay, and say that my principal now is going to be my balance minus $200 is now going to be $5,328.65. And then now with this number here, this is where I'm going to start calculating my interest again for the month of July to August, right? If I know this is going to be the 6.25% divided by 12, that means this number is going to stay constant. Okay? So in this case, right, I made a payment of $200, and this is how much is actually going to go to my actual principal, and this is the payment that I made towards interest. Okay? So now let's go ahead and calculate my new interest that I'm going to be collecting for the month of July to August. Okay, so in this case, equal round, my new principal of $5,328.65, okay, times the 0.005208. Okay, how much interest is going to be collected for the month of July? Or in this case, for the month of August?
$27.75.
Okay, 27.75, okay? So therefore, my current balance is going to be $5,356.40. Okay. So then that becomes my new balance. So I don't know why I have this column here. I think I just threw it in there. But you don't necessarily need this column at all because you just can take your current balance. So in this case, I'm just going to clear this out. Okay. So then I got to fix this real quick. So it's going to be this minus this is going to be your balance. There you go. So $27.75 is going to give you a current balance of $5,356.40. Okay. If for the month of August, I decide to pay $250, right? I'm paying more than last time. Let's see how much am I going to pay into my actual principal. Okay. So it's August 1st, right? You're going to make the same payments, right? Except this time you have a higher value in the amount of you're going to pay, right? At this time, you're going to pay $250 instead of $200, okay? How much interest are you going to pay for the month of August? Or in this case, for the previous month?
Interest is 27.75.
27.75 is correct. So then, how much of the money is actually going to go towards the principal?
222 and 25.
22225. Correct. Okay. So again, now I'm actually breaking some money here, but at the end of the day, you're always going to pay the interest off first. Okay. No matter what kind of payment you do, your first payment's always going to pay the interest off first, and then whatever remaining is going to pay off your actual principal. So in this case, right, my new principal for the next time is going to be my $5,356.40 minus out the total amount of payment of $250. So therefore, I'm now down to $5,106.40. Okay. So now let's go ahead and calculate the interest off of this or for the month of August. Okay. How much is going to be my monthly interest that I'm going to be collecting here? So 5106.40 times the 0.005208. How much interest am I going to be collecting?
Would it be 2568 7? Oh no.
Oh, you missed a couple numbers there.
Oh, I put the number wrong.
Okay, so in this case, right, you can cell reference so you don't so you can avoid of typing errors. Okay, so 2660 should be your total amount of interest. So therefore, my new principal is going to be 5133 even. Okay. So this time for September, I'm going to make a $300 payment instead. Okay. This time I'm going to make a $300 payment instead. So I'm going to pop in my for September 1st. Okay. This time if I'm making a payment of $300, how much interest am I going to pay off first?
The 2660.
Okay, 2660. So then how much of the $300 payment is actually going to go towards my principal?
273.40.
Good. Okay. And that's how you journalize it, and that's how you can separate it, right? And this is how a lot of the credit card companies or even anything kind of bank loaner, that's how they get their money. They expect you to pay the interest first, and then the other extra money goes towards your actual principal. Okay. All right. Any questions?
No.
Okay. Any questions? You had a question?